Hi, this is Jim Welsh from macrotides.com. Thanks for tuning in. Well, after the weak employment report released on June 7th, expectations that the Federal Reserve will move aggressively to lower the federal funds rate in coming months jumped significantly. The probabilities based on the federal funds futures that the Fed will act either at the July meeting or sooner jumped to 83%, with about a third, 35% probability that the Fed would act as soon as June. In addition, the Fed funds futures suggest that the Fed will not only just lower rates once, but will in fact lower rates more than 3 times over the next 12 months. So the obvious question has to be, is the market getting ahead of themselves in terms of anticipating and expecting the Fed to move so forcefully to lower rates? I don't think a rate cut at the June meeting is likely, and there are a number of reasons. You have to remember that the Fed has 2 mandates. One is for maximum employment growth, the second is stable prices. And if it weren't for the trade issue, there would be zero discussion of a rate cut at the June or the July meeting. Why? Well, look at it. The unemployment rate is at 3.6% and at a 50-year low. Unemployment claims have barely budged and are hovering just above the lows of the last 50 years. Wage growth has slipped a little bit from about 3.4 to 3.1, but it's still the highest level we've seen in a decade. The U6 rate is the rate of people who are working part-time but would like a full-time job. So they are the available labor supply. The U6 rate dropped to a 20-year low. So what that means is, irrespective of everything else, job growth would be expected to slow in coming months just because there's fewer workers to tap into from the sidelines. So clearly the Fed has fulfilled its mandate for maximum employment. The Fed has an inflation target of 2%, and depending on which inflation measure you look at, it's pretty darn close. The core PCE, which is the Fed's historically favorite target, is 1.6% in April, but more and more Fed governors have been talking about the Dallas trim mean inflation rate as being preferable. It's surely less volatile, and it was at 2% in April, and the core CPI at 2.1%. So clearly, inflation is stable and not so far under 2% that would really prompt the Fed to cut rates. So people are talking that the Fed will do a preemptive cut. Well, what they're not addressing is if the Fed does a preemptive cut, and then trade talks resume, and a deal is struck, all of a sudden the Fed would be faced with the prospect of having to take that cut away, and it would kind of cut into their credibility. So what will cause the Fed to cut rates? Well, by waiting, they'll get to see what happens, if anything, at the June 28th G20 meeting. They'll get to see the results of the July 5th of the June employment report, and be able to determine whether the weakness in May was a fluke or the actual beginning of a trend. They also need to see other data like retail sales, which comes out on June 10th, and more data to suggest, is the economy slowing more rapidly than we expect? I think that will take a number of months to get the Fed to force their hand. Current tariffs are only going to shave off 0.3% of GDP. So if no meetings take place, as long as President Trump doesn't ramp up tariffs in coming months, I think the Fed is likely to stand pat. But if he does move and does apply a 10% tariff or whatever on the $300 billion not currently levied, I think the Fed would be more likely to move quickly, because they would in that case anticipate that the economy would likely slow, and they'd want to get out ahead of that slowdown. Thanks for listening. May something good happen for you today.